Hey everyone, welcome back to the Ninja Options Warrior monthly educational series. Today we're going to talk about vertical spreads. We're only going to do an introduction, so we're going to cover some of the basics of a vertical spread. For those of you who don't know me, my name is Dorothy Hay. I am the creator of the Ninja Trade. I'm the lead options trader at ninjaoptionswarriors.com. Who I am not a financial advisor, and I'm not licensed by any governing body. I'm solely a trader, someone who has found success and continues to find success along the way, and I want to help others on their journey. Everything I produce and everything we do here at Dorothy Hay Associates LLC and ninjaoptionwarrior.com is for informational and educational purposes only. So let's get right to it. What is a vertical spread? Vertical spreads are the most basic options trading strategy, and they're used as building blocks for more complex strategies. You may have heard of some of them, like the iron condor, the butterfly, the straddle, the strangle. There are so many different strategies out there. But you must understand and learn the basics using with the vertical spread. Now, what are they? What are you actually doing? You are buying and selling options of the same type, i.e. calls or puts, with the same expiration, but at different strike prices, and you're buying them simultaneously, or you're opening the order as one order. You're buying one option and you're selling one option at the same time. Now, this is a directional play, and it's based on your technical analysis. Keep in mind, the option closest to the current market price determines the direction of the trade. So a couple of things you want to know, the net debit versus the net credit. You might hear that a lot when, with folks who trade the spreads. Oh, I'm opening for a net debit of X, a net credit of X. What does that actually mean? All a net debit means is that you paid out more than you collected. If we buy the front option and sell the lower option, it equals a net debit, right? So it's costing you more than you're collecting. In this example down here, you'll see this is just a straight up vertical bull call spread on Apple, because you think Apple's going higher. So you say, you know what, I'm going to buy this 245 call, and I'm going to hedge it by selling this 250 call. So remember, when you sell a call, you're collecting the premium. When you sell an option, you're collecting the premium. So here, we're buying this 245 call, and it's trading at between 715 and 750. And let's just say we paid $7, and we're selling this one below the 250, right? So we're collecting a premium here, but we're paying out here, and this is higher than this, right? So we're going to have what's called a net debit, which is, I guess in English, the easiest way to say it is, it's what the trade is going to cost me. It's what I'm going to have to pay out of my pocket. And in this scenario, I'd have to pay $2.50. Now, keep in mind, one option represents 100 shares of the stock. So $2.50 times 100 would be $250. So this one vertical spread would cost me $250. Net credit is if you're selling the front option and you're buying the lower one, now you've got a net credit. So in this scenario, let's say we think Apple is going down. So we're we're selling the 245. So we come up here, we're going to sell this 245. That's trading between 750 and 750. And we're going to buy the $250 call. So do you see, we're actually taking in a premium. We're collecting money here by selling this, and we're paying this money here by buying it. So there's going to be more left over, right? I'm actually collecting more than I'm paying out. So there will be a $250 credit. Okay, you with me? There are 4 basic vertical spread strategies: the bull call, the bull put, the bear put, and the bear call. Now, a bull call, which we're going to go through in more detail, I'm going to use this as the primary example. In this scenario, we're looking at Apple, and this is a bull call spread with an expiration of November 15th, right? Both of them will expire at the same time. Remember, you're buying one, you're selling the other in the same expiration, the same type calls, but with a different strike. So again, here we're buying the $245 call. So we're buying this $245 call, and we're selling the $250 call. That's this one right here, the $250 call for a net debit. Remember, we're paying more, then we're collecting. So there will be a net debit in this scenario of $2.50. Now, the beauty of Thinkorswim is, and probably your platform as well, is it already figures out the numbers for you. Now we're going to use a simulator. We're going to do a couple things later, and I'll show you how you can adjust this price if you like, you know, based on your analysis. If you think, like, for example, Apple's going to have a little pullback, so you want to wait, you don't want to pay right at what it's trading for, you might want to wait for a pullback and adjust your price. All kinds of little things you can do, but just keep in mind for now, a bull call spread. This is a bullish, that's why it's called a bull call. It's a bullish trade. You think Apple's going up, you're bullish on Apple, so you would go with one. This would be one of the opportunities. Next is a bull put spread. Now, if you think Apple's going up, you could sell the puts, right? So you would go short the front option, right? You're going to sell this 245. So now we're looking at a clip of the Apple options chain, but we're looking at the puts side, right? This would be on the right side. So we're looking at it and we say, okay, I'm going to sell this $245 put, same expiration, right? Same November 15th expiration on both. I'm going to sell the 245 for $6 and change, and I'm going to buy the 240 for $4 and change. So because I'm selling it, I'm collecting about $6 and I am paying out about $4. So I'm going to have a net credit of about $2 here, right? You with me? All right, a bear put spread. Now, this is where I'm now saying I'm bearish on Apple. I think Apple is going to go down. I've done all my analysis, and I actually think, based on my technicals, that Apple is going to go down. And so I am going to buy a put, but I'm going to hedge it by selling the lower put. So you remember, the one closest to the strike, the current trading price will determine the direction. So I'm buying a $245 put for about $6, and I'm selling the $240 put for about $4. So now this is a net debit, remember. So now this is costing me. In the other scenario, I was collecting money. Now I'm paying out. So this is going to cost me $1.98. And this is an opening order. So you're buying to open and you're selling to open. Again, the beauty of the platform is you tell it you want a vertical and it'll set this up for you. And then I'll show you how, when we go live, to how you can adjust these strikes and the amounts. I'll show you that in a moment. Now, you can also be bearish on the call side. How do you do that? You sell the front call. So if you were bearish and you think Apple's going to go lower, you're going to say, you know what, I want to sell the 245 call. So you come over here, the 245 call, I'm going to sell it for about $7 and change. And then I'm going to hedge that by buying the 250 call for $4 and change. But remember, I'm selling this one. So I'm collecting $7 and change. And here I'm paying out $4 and change. So I'm actually going to have a net credit because I'm actually receiving money from this trade. Okay, so let's get back to technical analysis. You absolutely must do your analysis if you're going to have a higher probability outcome. Otherwise, it's just gambling, right? You can say, oh, I think Apple's going up because it's a good stock and I like it, and so I'm just going to throw money at it. That is your absolute right. Do I recommend it? Absolutely not. I would go in, I'd look at the Apple's daily chart and my intraday chart, and I want to really take a look at it. And again, we'll do it live in a few minutes, but I want to look at the chart and see, do my analysis and see, where do I think Apple's going to go? And once I determine where I think Apple's going to go, then now I'm choosing a higher probability direction, and then I have a few different options on how I want to trade it. So let's say I looked at the chart and Apple looks good. I think it's heading for 250 based on my analysis. And so I think at the open, we're probably going to have a little pullback. It looks like there might be a little bit of profit taking there. It's a nice little resistance level it's hitting. So I'm going to wait for it, because at the time Apple was trading at $246, but I'm going to wait for it to pull back to 245 before I actually make an entry in the trade. So the first strategy I can use is I can go long Apple stock, right? I can just buy 100 shares of Apple. So now Apple pulls back at the open at 245. I buy 100 shares at $245 a share. 100 times 245 is 24,500. So this is what this trade is costing me. I've got to pay out $24,500. And I'm looking for a $5 move in Apple. So I've got my sell in. When Apple hits $250, I want to sell my share. So I would have already put my sell order in, and Apple hits $250, and so I sell it and receive $25,000. Now remember, I paid out $24,500. So my profit in this scenario is the amount I received, $25,000, minus the amount I paid out, $24,500, for a profit of $500. And so what does that mean percentage-wise? If you're like me, I love those percentages. That's a 2% win. So in order to make $500, you had to pay $24,000, over $24,000 to make $500. That's one strategy. Let's look at another strategy. Let's look at a discount. We like those discounts, right? Let's look at a discount. So let's go now. Let's just say we look at Apple, and we're going to look at the options, just a straight naked option. We're going to buy the calls. We think Apple's going up, and I'm going to come in here and say I waited for a little pullback. So let's just say for ease of numbers, I paid $7, right? I've got one call for $7. Now remember, one options contract represents 100 shares. So a $7 option contract would cost me $700, right? 7 times 100. So this is what I'm paying. Remember, the previous scenario, I paid $24,500. Now I'm only paying $700. Big difference, right? And I'm going to sell my option when Apple goes up to 250. Now at a delta 50, this is a delta 56 here, so it's a little higher. I'll probably reach a nice target a little sooner, but I'm just going to call it a delta 50 for ease of the math. And Apple goes up $5. So if Apple goes up that $5 at a delta 50, which means I'm going to make 50 cents on the dollar for every move Apple goes up. And if Apple goes up $5, well, I just made $250, right? $5 times 50 cents is $250. So I sell my call at $9.50, right? Which is the $7 I paid plus the $2.50 that I just made at a delta 50 or higher times 100. So I sold it for $950 basically. I paid $700. I sold it for $950. That gives me a profit of $250 or 36%. Okay, you see that? So look at that discount. So now I only paid $700 and I made $250. In the previous scenario, I had to pay over $24,000 just to make $500. This is the beauty of options, right? You can significantly discount. You put so much less capital to make the same amount of money or even more many times than if you had to put out tens of thousands of dollars. Now let's look for an even deeper discount. Option 3 or strategy 3. We could either do a long bull call spread or we could do a bull put spread. But in this example, I'm going to go with the long bull call spread. November 15th expiration, same expiration. And I'm going to buy to open, right, the $245 call, and I'm going to sell the $250 call. So I'm going to hedge it. So now instead of costing me $700, now it's only costing me $250. And the net debit, which is the cost of the trade, is $250 because it's $2.50 times 100, right? So now, remember, I went from paying over $25,000. Now I'm paying then I went to $700. Now it's only costing me $250. Now, the maximum value of this spread is the strike width, which means however much money there is between these strikes is the most amount of money this strike will be worth. So in this case, 245 to 250 is $5. The maximum this spread will be worth is $5. If I'm paying $250 for it, that means the maximum I can make is $250. right? Because $5 minus 250 is 250. So, but here's the beauty of that. That's 100% profit on my 250. Remember, in the previous example, I had to pay $700 to make 250. Now I could make 250 100% return on my money, only putting out 250. Really neat, right? The good news and the bad news, right? The good news is, yeah, you can do 100% return. However, that's the maximum you can make. So if Apple shoots up 10 more dollars, the maximum you can make is $250. You can make a lot more on your other option. If you bought this option here, the 245 for $7, and Apple went up $10, so you're going to be up a minimum of $5, probably more like $6, because this delta keeps increasing as it goes further in the money. But so you bought it for $7 and you're selling it for about $13 now, right? So you just made $600, almost 100%. You probably had about 80%, 90% on this trade, just buying the option itself. But the same move, you cannot make more than $250. That's the downside for some people why they don't like the vertical spreads, is because your maximum profit is capped. But on the good news, and the better side is, so is your maximum loss. You cannot lose more than $250 maximum. Whatever you pay for the spread is your maximum at risk. So how do you do this on Thinkorswim? I'm going to show you this live in a moment, but if you want to, and you want to pull it up, you can go to the Analyze tab. You look at the top of your screen. You go to Analyze, then you go to Add Simulated Trades. You type in the Apple ticker in the upper left window, and then you right-click. It pulls up an option chain, and you right-click on the option you want to buy, and then you select Analyze the buy trade. This is if you want to do it before buying. You don't want to buy it, you just want to analyze and see how much you could actually make and how much you could lose. And then you fill in the info and you click on the risk profile. And this is what you're going to see. And again, we're going to go live on this in a minute. This is what you're going to see. So in this strategy, the fuchsia line represents the date that you select. So it defaults to the current date. But I had gone in and put in the 30th. Today is the 27th. So I said, oh, Apple has earnings on the 30th after the market. So if I bought it tomorrow and held it until the 30th, and it's at about $250, let's just say we get a slight move, get that $5 move, it's at $250. That's this white line here. You can see it's showing me how much I would be making. So if it moves to $250 in the next few days, I'll make $55, right? And so that would be about a 20% return on, 22%, excuse me, return. On my $250 cost, I'd make $55. The blue line shows me the profit at expiration at the same price. This is the price axis down here, and this is the profit axis, profit up here. And so at $250 on expiration, you see where it shows you here at expiration, I will be at my max profit of $250 if Apple is at $250 on November 16th, on November 15th, really. This is the next morning when it all settles, but on November 16th. You with me? So 3 things you want to know about your spread. The maximum profit in this long bull call spread, the maximum profit, $250 as I, $2.50 as I mentioned, times 100 shares is $250. Your break even is the long call's strike price plus the net debit paid, plus whatever you paid for it. So in this scenario, we paid $2.50. The long call strike, remember the first call we bought was $245. You add those together, and if Apple is at $247.50, you neither make nor lose money. This is your break-even price, which means your long call will be worth $250 and your short call will be worthless. Okay, so you would basically break even, and you're not going to make anything, you're not going to lose anything. Your maximum loss, as I mentioned before, is the net debit, which is how much you actually paid for the spread. So if you pay $250 times 100 shares, that's $250. That is the maximum that you will risk. Whatever you pay for your option is the maximum you will risk. Now keep in mind, when you're trading naked options or spreads, you want to use the charts for the underlying security the same way you would as if you were trading the stock itself. We trade particular setups on the stock chart using the options as the instrument. We do our technical analysis using moving averages, indicators, etc., based on the underlying stocks chart. All right, so let's go over to Thinkorswim, and let's take a look at this in real time. So here we have Apple's chart, and here, you can see the time, the date and the time. Here we have Apple's chart, and I did my analysis already. We actually traded Apple back here for the first move up to the symmetrical level. And I remember those of you who are watching this that are in the Ninja Live room with me, remember me saying I was looking for a price of about 246 on Apple on its way up to 250. I thought we might see a pullback there, and look what happened. It literally stopped at 246.58. And so I'm looking at this now, and I said Apple has earnings on the 30th after the market closes. So maybe I pick this up tomorrow because today's Sunday as I'm recording it. So on Monday morning, Apple has a little pullback. Some people take some profits because these fib levels are places where there's resistance and some profit taking. So let's just say we open up and folks took some profits, and now we're down here about 245, which is what I'm looking to enter at. But I like that it's up in this uptrend, right? I'm doing my analysis. You do your analysis however you do it. How you trade it is how you trade it, right? You can trade the stock, you can trade the options, you can use a spread. But the foundation is you must be able to do your technical analysis. So I'm looking at this and I see Apple's in this uptrend, and I see, I actually think we start seeing some institutional selling soon on Apple. But at least for the short term, Apple is heading up. It's at these nice highs. You've got this squeeze that's fired long. It's got about a $3, almost a $4 range, a daily range. So it's a high probability for me that now, I've done a lot more than this. I'm doing the super abridged version of my analysis. But I've determined that I think Apple might actually make that psychological level of $250. So I'm willing to give it a shot here and see. But before I do, I want to take a look and say, well, let's do an analysis. Let's look at it. Let me get out of here because I was already in it. But I'm going to go here and I'm going to say, okay, I want to add a simulated trade before I do anything. And I'm looking at this vertical spread, and I think I'd like to buy the 245, right? And so I'm going to analyze it, the vertical. And I want to come down here and make sure I only want one. I'm not buying 10. And you can adjust it to as many contracts or spreads as you like, right? So one spread is going to cost, in this scenario, $1.43. But I'm looking to buy the 245. You can adjust your strike prices here. And you can also decide, you can change, you can customize your vertical, but I just want, I want to let Thinkorswim figure out the main ideas for me. And I'm going here and I just want to I want to sell the 250 against my 245. So right now this is going to cost me 260. But remember, I said I think there's going to be a little pullback. So I would actually want to look at it paying $2.50. So I'm going to adjust that to 250. And let's see, I changed the date here. You see how you can change the date? And you can change the slices. I changed them before they were dollars, but I like to look at the first one standard deviation. I'm not going to do a statistics class here, but those of you who are familiar, you know what one standard deviation is. And I'm going to come over now to the risk profile. Now that I've set up all my parameters, I'm going to come to the risk profile, and this is what I was showing you on the slide. Now you're seeing it in real time. So this line down the middle shows this is the current price, right? This is the current price of Apple, which is $248. You can see it over here on my watch list, $46.58. And these parameters here represent one standard deviation in either direction. So if now on this fuchsia line, as I showed you on the slide, this is showing, see how the number on the bottom, pay attention to this number here. See how the number changes? Because this is saying I'm looking at this going, okay, I'm going to buy it Monday and I want to sell it on Wednesday the 30th before the close because I do not want to hold it through earnings. You may want to hold through earnings. I personally would not want to. So I don't want to hold it through earnings. So I just want to see, let's see, if Apple hits my 250 by Wednesday, how much will I make? And see the number down in the bottom left? Right here, it's about $55, right? $54 and 50, let's just call it $55 for ease sake. So if Apple hits 250, I'm gonna make about $55 on Wednesday. Now, having paid $250, we figured out that was about a 22%. Now, if I hold it through expiration, and if that expiration, right, I'm gonna close this, I'm not gonna let it expire, I'm actually gonna close it before it expires on the 15th at 4 p.m., I would close this out. So if Apple on the 15th is at $250, look in the bot, look at the blue, this light blue here, bright blue price. It's going to show me if Apple's at $250 at expiration, I'm going to make that full maximum profit of $250. Now, if Apple's at $260, I'm going to make, see it, the number doesn't change, $250. Apple runs up to $280. I'm going to make $250. Apple goes even higher, doesn't matter. Even you'll see my December 30th, even if Apple runs, if I accidentally forgot and held it through and forgot to sell or didn't put my sell order in, or, you know, before the close on the 30th and it goes through earnings and Apple soars, I'm only going to make $250. On the flip side, if I forget to sell it and Apple just goes, you know, because it happens sometimes, and Apple drops down to $220, right? On the 31st, I wake up, I go, oh no, I forgot to sell my Apple spread. And now I'm down $235. See it in the fuchsia? I'm down $235. Now what do I do? Well, probably the best thing to do, because right now you've actually, this is actually kind of in your favor in terms of time. You've got 2 weeks until expiration from this point. So would I sell it here? I wouldn't, because I've only got now $15 to lose. But there's actually a possibility, depending on my technicals, I would redo my analysis. And actually, what if Apple rallies, right? The following week, Apple just comes right back up and rallies. And let's just say, even if Apple only makes it back to, let's just say Apple only gets to 240. Look how much I'm down. Now I'm only down $83. Let's say Apple gets right back to where it started, you know, where I bought it at. Now I'm only down $7, right? $10, or excuse me, now I'm up. I'm up $8. If Apple gets right back to where it was, I'm now, instead of being down almost $250, right, down $230, I'm up $8. So it's actually in my favor to hold it through to expiration. If I'm down that much overnight or something happens, I know on one of my testers that happened, I think it was Netflix, and, you know, and I'm like, well, at this point, I'm just going to hold it. I'm not going to, you know, what's the point of selling it when I can lose $5 or I can make 400? Does that make sense? And so let's say you do your analysis and you like the odds and you like how, you know, this trade looks, and you could do one of two things. You could either close it here, right? You can, execute your buy order here, or I probably wouldn't do that. I'd actually want to come out to the real trade itself, because I want to see the open interest. You notice on the analysis, when you're looking at, when you were looking at the simulated trade, let's see, can we do it again? Let's pull up a different one so it will show me the options chain. Okay, so you see what's missing here. I mean, I'm sure I could probably add it. Let's see, volume, open interest. Okay, so it's showing me the volume and the open interest. Yeah, but what I really want to do is come out here and I want to see this open interest. I want to see, you know, the liquidity of this. And so now I'm going to come here and say, you know what, I like it. I don't have to do, or maybe you don't want to use the analysis tool and you say, yeah, I'm pretty sure I like it. So I'm going to buy the vertical 245 and I'm going to sell the 250. See how I adjusted it there? And I only want to pay 250 for it. Oops, let's just type it in, might be faster. 250 and I only want one. Make sure you only have the amount that you want, right? Don't be too quick to press. You want to make sure that your order is lined up. Just check it. And when you go to confirm it now, if I'm going to pay $2.50, let's just say it pulled back and I could even get it at a better price. Let's just say I end up paying $2.35 for it. Yeah, I think I'd want to pay $2.35. So remember, the maximum value of this spread is $5. So we take 5 minus $2.35. Now the max I can make is $2.65, right? See that? The maximum profit is $265. How did I arrive at that in my head? Well, it's a $5 spread width here, and that is the maximum value of this spread. If you want a higher, let me delete that. If you want, didn't mean to delete the whole thing, sorry. If you want to make more money, then you can go have a wider spread, right? Maybe you go to the $2.55. Now there's a $10 spread, but you're going to pay more and you're going to risk more, right? Or I can go, let's say I want to do a $15 spread. I can do a $15 spread. I'm going to pay $5.74 or $574. Let's just say I only want to pay $5 for it. So I want to wait for a pullback, see if we get to $5. And I'm now going to make, say, I know $10,000 tells me right away I had too many on. I should have edited it. Hold on. So now I want to do a $15 spread. I only want one. And I'm only going to pay, yeah, I'd be willing to pay, let's say, $6. I'd be willing to come up to $6 on this one because I did all my other analysis. And it's a limit. I don't want a market order in. And this, I only want this order good for the day, but you could do a GTC, which is good till cancel for the next 90 days. You could put that order in, but I only want to do it for the day and from the best exchange. So when I go to confirm and send, this tells me right here, my maximum profit. Remember, this is a $15 wide spread now. So for $6, I can make 150% on my money. I could pay $600 and have a profit of $900 at expiration, okay? But I'm risking more than I would with if I had a $5 spread. Make sense? Now, once I execute the order, in order to sell it, you just go over to your monitor tab and you right-click it, just like we did on this. We were analyzing, let's see, we had an Apple. And when you right-click it, at the top, it's going to say create selling order or closing order. It'll say create something like that, create closing order. And you can close the entire spread or you can close one leg at a time. I personally would close the entire spread. I'd create that order to sell it. So if I paid $2.50 and I did my analysis and I know, it's going to be worth $3.50, so then I would just put the selling order in for $3.50. Or I would look at it, I'd also monitor it because it's going to show you, I actually have one on here, a closing order. Let's see, where is it? Here it is. So I've got an order here for PVH and I want to sell it at $1.15. I paid 85 cents for it. So it's up 87 cents. It was like at 95 cents the other day. But I could always close this at any time. I could cancel and replace. Right? So I'll cancel that and I'll replace it. I'll say, yeah, I think I want to sell it at, $2 or whatever. And I could just cancel it, replace it, do a different order. But in order to close it though, you have to create that closing order because remember, even though you sold one and you bought one, to create the closing order, you do the exact opposite. So remember, I bought in the Apple one, let's go back to that analyze, we were buying the $2.45 and selling the $2.50. So in order to close this out, I would now have to sell the one that I bought, right? I have to sell the $2.45 to close, and I need to buy to close because I sold this one, the $2.50. All right, makes sense? You just do the exact opposite. However, your platform should already have that set up for you. So I hope that was helpful. I just wanted to give you a very basic introduction to spreads. And if you liked this video or you found it helpful, please be sure to like it and share it with folks you think could use it. And be sure to subscribe to my channel for more videos like this one. We're building the library. Every month I have a monthly educational series. And for additional resources on building your financial portfolio, trading options with us, visit us at www.ninjaoptionswarrior.com. And I want to say thank you for allowing me to share this with you. Now, if you're looking to do more options, come on over to the Ninja Live Room. You know, we have a free day that you can come and check us out, or just come on over, and it's a really great, tiny but growing community of really awesome folks. You know, we're over here building our portfolio slowly but surely. The majority of our trading is via my signature ninja trade and my overnight ninjas and my weekly swing trades, but we trade the first hour. We have a lot of fun in there, make some money, take that money and run. And for the spreads, we're using those for our swing trades. It's a really great strategy to use less money to get this, take advantage of some of the higher priced options that you can trade instead of paying even $1,000 for, you know, maybe a higher price like a Tesla, or $3,000 for an Amazon. You might pay $500. So I hope this was helpful, and I want you to know I truly wish you the absolute best on your journey. Thank you again, and God bless. Enjoy the rest of your evening.